Examples. First of all, thank you all for being here. I am getting your comments on the chat, and I am very happy that you are all here with me. Please, if you have anything in mind, you can ask about it, especially if it's about the discussion that we are having right now, this technique, or any other question you may have. I'm here for you. I want to give you information. I want you to be successful. I want you to make money and come back to me and to FX Educast and say, you guys helped me. That will make us very, very happy. We want you to be successful. We want you to make money. So let's go on with our example. As you can see, I did not place any drawing tool, any technical tool on the chart aside from the moving average. I have not drawn any trend lines. I have not made any attempts to identify the trend aside from looking at the chart. And come on guys, look at it. Tell me, look at the first part of this chart. And we were at 114 early in July, around probably 4 or 5 days before the end of June, we were at 114. Early in July, we were at 113. And during the month of July, and the first 10 days, we had dropped to 112. So I don't think that it is hard to see that the main trend is down. So on this chart, the main trend is down. Once we find out and we reach the conclusion that the trend is down, we try to draw a channel. Okay, on the upper side, we can use the first two tops to draw that. But if we take the bottom of this channel and place it on any bottom, on any price bottom, we will not get an elegant channel. Being elegant is one of the best things about channels. So when you draw a channel, of course, you have to try different tops, different bottoms, until you reach the channel that you think is elegant. In my opinion, and I have drawn this channel at that time, this is the elegant channel that we need to follow. We have seen two price bottoms in July, and then after drawing this trend line at these two bottoms, we take a trend line with the same slope and we place it on the top of the recent price top, and we get ourselves this channel. Okay, after that, we can see, of course, that for most of the time, the price is moving below the moving average, but not all of the time, of course. Below, 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 attempt to break, it fails, we go back below, 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 and here we start moving higher. Once we start trading above the moving averages, of course, the first thing you will think of here is this is a buy, and you cannot be wrong here. Of course, we use moving averages. We should always listen to what moving averages say to us. If we see an attempt to break higher, a close, an hourly close or 4-hour close in the green above the moving average, then it's time to buy. You might say to yourself, okay, why did not we do this here? Well, just take a look at this. Do you see any green candle closing above the moving average? Red, green below, red, red. We have maybe 1 or 2 pips close above the moving average, which is not enough to constitute a break. So here there is no hope for the bulls. Here you will not be blamed for taking a long position here, as long as you place the stop around here, and this could be one of the signals that did not work. Of course, remember that no method at all gives you 100% accuracy, and if you spend some time on the social media, like I sometimes do from time to time. I don't like to spend too much time on that, but I like to see what people say about trading and Forex on the social media, and sometimes you find unbelievable claims by people who, maybe I should not say scammers, but they probably are. I don't know them personally, but they probably are scammers who tell you that they can give you signals with 100% accuracy or something like that, and yet they are trading on their own. They are not known to the world after achieving such a miracle. If you can give 100% accuracy, you will be known in the whole world. People will come to see you on video, will come to see your seminars, will want you to train them. So some people claim that they can give you 95%, 100% accuracy. I don't know about that. I've never seen anybody does that, and I've worked with people working in the tens of millions, in different countries, and nobody can do that. So always be prepared to accept that losses are part of the game. And why I'm talking about this, of course, I'm talking about this because of the failed signal that the chart has given us around here. So let's get back to the technique. What does this technique offer us after trading above the moving average? After trading above the moving average, we can expect the price to, let me just turn to the screen. Sorry about that. The camera is still on me. After the price moving above the moving average, it is time for the price to rise. And when we have a main trend that is falling down and a rising price that is moving up, this is exactly what we call a secondary trend. This is a secondary trend. This is the main trend, and every recovery attempt within it is a secondary trend. Okay, this is a very good example of a secondary trend because it moved higher, it broke the moving average, and it reached the first Fibonacci level of 38%, which is typical of corrective moves. Corrective moves usually reach at least one of the Fibonacci levels, 38%, 50%, 62%, and that is when you need to keep your eyes open when any recovery attempts after falling trend or after, of course, it's the other way around when the trend is down. Let's talk about this example. The trend is, the main trend is down. The recovery attempt is up. We stop around the 38% level. We need to keep an open eye around here to see if there is any sign of weakness around the Fibonacci level. If we see signs of weakness, we can go short. If we don't see, I have to stop this. Thank you, Jack. Yes, I am a huge Lazio. And I thought to myself, I think of trading as I think of football or any other kind of competitive sport. It's a game. It's exciting. When I was younger, I used to love football so much, and when there's a big game, I used to leave everything. No positions on that day, believe it or not. Like 10 years ago, I did not even open positions for like 4 or 5 hours before the game. So when the game starts, I have nothing in the market and I can focus completely on the game. And you get the same kind of rush, get the same kind of rush from competition in anywhere. So in markets, when you are in a financial market, you are in competition. You want to make money. You want to be one of the winners, not one of the losers. And when you're on the field, of course, playing football, or you're a fan watching your team, of course, that's also competition. So the same kind of energy and excitement resides in football and in Forex. And that's why I decided to wear this shirt. I was in the Olimpico last year, and I watched my team there in Rome, and I was very, very happy. So just like when I make money in the market, I had the same kind of feeling. You're happy, you're making money, or you're watching your team winning, and we all need this kind of excitement. It makes life much, much sweeter. So you guys, No matter what team you like, project. No matter what team you like, I wish you and your team the best. And always have this in mind that you are in a game, you are in competition when you are in the market. You put your money there. You try your hardest to win, to score. And you score when you have a winning position, when you close a position with profit, just like your team scores and the game ends with their winning 1-0, 2-0. That's exactly the same kind of situation when you are in the market and making money. Question about Fibonacci retracements. Of course, we will talk about Fibonacci retracements. We have to talk about them. But at the moment, it's not the topic that we can discuss right now because we are in the middle of the technique hour and we are talking about the technique of the secondary trend, and we have to finish with the example. Okay, so after talking a little bit about football, let's get back to our technique for the day. Okay, you guys, so we were talking about the secondary trend, breaking above the moving average and reaching a Fibonacci level. That is amazing, that is good, that's great. And secondary trends, they give us the opportunity to get in the market at good prices. So, if we draw a trend line that starts with the beginning of this secondary trend and connect it to this bottom right here, we can of course connect it to this one or this one. The difference will be only a few pips. It's not a huge difference, of course. So we draw this trend line and we can see that the secondary trend moves up and down above this trend line for a period of time, and eventually of course the main trend is down, so the potential of the market going down is higher than the potential of going up, and we will be waiting for the market. This is very important. We will be waiting for the market to give us the signal that it is time for the main trend to resume. During the secondary trend and any part of it, we should be ready. We should have our cash, our account ready for the next position. And in this case, of course, the main trend is down, so we are looking for a position to capitalize on down movements. And of course, that is a short position, a sell position. I am seeing this, the trend is down, main trend is down, a secondary trend is up. I am waiting for a chance to get in the market and open my short position on the euro dollar. Okay, when does that happen? Well, first of all, if you have sold when the price touched the Fibonacci level, that would be okay. That's no problem, as long as you have a suitable stop. And the stop in this case could be a little bit, probably 50 pips. Why is that? Because if I sell here, if I come to the market and see the situation and it touches the Fibonacci 38%, and I say to myself, well, okay, at 38%, I want to sell. We touched Fibonacci. That's good enough for me. The chart is down. The main trend is down. That's enough. I want in. Okay, no problem with that, as long as you have your stop above the falling trend line. So I sell here. I place my stop here. Okay, sell at 12.75 probably, something like that. And the trend line is around 13.20. So at 13.30, 13.40, around this area, I place my stop. If the price goes up, it's okay, let the stop hit. We don't need to make money on every trade. Sometimes we lose, and that's perfectly fine. If it does not hit the stop, then my short position will be making me money soon. So, first of all, it's okay to do that. It is okay to do that. There's no problem with that, as long as you have good protective stops. But this is not what this technique is teaching us. This is a Fibonacci entry. And we will not be talking about Fibonacci today because you guys are asking about it. This is probably the second question about the Fibonacci retracement. I will talk about it in details tomorrow. In the technique hour, we will be talking about the retracement levels. Because first of all, it is a great technique to use. And second of all, you are asking a question about it. Obviously, you have interest in Fibonacci retracement levels. So let us continue with today's technique, and we'll talk about the retracement levels tomorrow. So entering here, getting in the market at the 38% level is not a secondary trend technique, it's a Fibonacci technique. So where is the secondary trend telling me to get in? Let's go back to the basics of technical analysis. A trend, whether it's minor, secondary, major, or any kind of other trend, main trend, the trend is assumed to go on as long as it does not give a signal of reversal. And the most basic tool that we use to check if a trend is giving a signal of reversal or not is the magical, and yet so simple, trend line technique. The red trend line on the chart is the trend line that protects the bottoms of the secondary trend line. Once we start trading below this trend line, then the secondary trend is gone. It is finished. This is the most basic thing in technical analysis. Trends terminate, they change, they continue until they give a signal that it's over. And when one of the best signals that it's over is with a trend line break. So around here, just when we started trading below it, of course we need to wait for 10, 15 pips, not 2 pips and 3 pips. This is not a break. Of course we need like 10 pips, 15 pips below this trend line. And of course, because it's a rising trend line, the 15 pips here, maybe we needed to see the price here before shorting, but when it rose, we only need to see the price here. At the time of the break here, it's probably at 65, so at 1250 could be 55 to 50 could be the right place to get in the market. Okay? And it's obvious, before moving to the next example, it's obvious that the price did move within our expectations, and we have made good profit on this trade. The target of such moves should not, to tell the truth, should not be below this level. So if we move, if we start moving lower, I assume that we can take down the bottom that the secondary trend started from. This is the bottom of the secondary trend. We sell here, we assume that the price will go below this level. If it does not, that is one reason to always use protective stops. You know, if I sell at 50, at 20, I have 30 pips of profit. When I have 30 pips of profit, I place a stop at 10 pips of profit. If my profit goes down to 50, like it did here, maybe I place the stop at 20, 25. Maybe I decide to take these 50 pips. So risk management is always key, because sometimes we reach the limit and we reach the target, suggested target by the technique. And sometimes, even if the technique works, it does not reach the ideal target. And this word is very important, ideal. So when we suggest these targets, they are ideal targets. It's not a must to reach the ideal target. Sometimes we get close to them, sometimes we surpass them, sometimes we don't reach them, but we still make profit. Be ready to act. If you have 50% of profit and you see a reversal sign, you see another sign on the chart, a candle, RSI reading, anything of that sort that says that the price will start rising again. I have a short position, I have 50 pips in my hand, why not turn those 50 pips into cash into my account? So I close it. If I decide, no, I want to wait, I want more than 50 pips, that's okay, that's fine, as long as you place your stop on profit. See, one of the trading rules that we'll be discussing is never make a winner turn into a loser. A winning trade should not turn into a losing trade. A pip one is 100 times better than a pip plus. So when you are making 30, 40, 50 pips, always get into the habit of moving your stop to the profit zone. Always do this, no matter what you think of the market. No matter what you think of the market, you should always use this. And believe me, one day you're going to remember these words and to thank me. Okay, another example from the same chart. Uh, this is the secondary trend we were talking about, and the price moved lower and then moved higher again. Okay, once the price fails to drop below the previous bottom, which is our target should be around here, and we did not reach that, and we started rising again, then we can reach the conclusion that the secondary trend is not 100% over yet, and there's still another part to it. If you are an Elliotician, if you know Elliott wave, you will immediately identify this move as a flat corrective move. Flat corrections are sideways corrections that consist of basically three moves, within, of course, inside moves and inside waves, smaller waves, but the basic outside structure is 1, 2, 3, where 1 and 3 come to top around the same level, and also the bottoms are not very far from each other. This is a flat. So if you are an Elliotician, you would see that just by topping here, there is a great chance of moving lower. Another thing that will support your idea and your thought of the price dropping from around these levels, around 1280, is the fact that we are still trading inside the falling channel. You know, with all this sharp and very good recovery attempt, it's very impressive. Even with such an impressive move, the price was unable to trade above the top of the channel. And that says something, doesn't it? It says that this thing is weak, that we are not able to break above the falling channel. And as long as we are inside the falling channel, then there's no reason to believe that the main channel has terminated. This is very important, guys. Even the main channel will come to an end. Even the main trend will come to an end. But that happens only when the channel is broken. Even if the price rises inside the channel, that's not a break. This is definitely not a break. And there is no reason here to believe that this rising move will continue. We have the flat Elliott wave count, corrective move, and we have the channel top pushing the price down. So a sell here is something a real great analyst, professional analyst, who is watching Elliott waves and watching the trend channel at the same time can make. Okay,